Hello and welcome to Swift Education. My name is Hilary. Sometimes when we talk with friends, they tell us about investment or something that we can put in our savings so that the savings grow. And friends speak to us about investing in shares. But have you ever thought about investing in shares? Have you ever had a second thought? What is the value of investing in shares? So I'd like to have a very basic method where you can check if it is worth investing in shares or it is not worth investing in shares, because friends will come and tell you that a certain firm has high share value, let's invest in it, or a certain firm is a small firm, so let's invest in it so that and grow. Let us do this and do that so that we can earn or increase our income. But before you make that investment decisions to join a circle, to join a bank, to join any company, to buy the shares of any company, you have to have a prior understanding or a history of the firm. Let nobody lie to you that dividends are the measure of making an investment, because sometimes firms may not pay dividends for over 3 years. Will you be waiting for dividends for the next 10 years or for 8 years or more? No. You ought to have a way in which to check whether it is valuable to invest in the firm or not valuable. But how do you do that? Because most of the time our friends tell us that let's invest in it because they pay dividends every year. They pay dividends twice a year. I'll give an example. There's a fruit tree that is grafted. It only gives fruits. But there's another fruit tree that has seeds, so that after every season, the seeds germinate and the plantation grows and grows and becomes a bigger plantation. So you should focus not on dividends only, because when you focus on dividends, you will be focusing on the short term. You will be focusing on the grafted tree that does not reproduce. But when you invest in a farm that grows, you will be like investing in a plant that has seeds that regenerate and grow so that in the end of a period, you will have a plantation. So let us check how you can check the simplest method, though this method is not applied right now because there are other sophisticated methods, but it gives you a glimpse of what is supposed to be done before you make any investment. Let's check some of the basic information that you need. You need the share prices of the company for a period of 1 year, 2 years, 3 years, 4 years, 5 years, or even the maximum period that you can find. Let the person that is telling you to invest in the shares of that company give you the share prices of the firm. Has the firm been increasing in value? It is better for you to invest in a firm whose share prices increase. Let's say in the previous year it was $1. Each share was $1. After 5 years, let the share price be $4 so that you can see that the share prices have gone up 4 times. So if you bought shares right now, let's say 1,000 shares at $1, after 4 years, you will have 1,000 shares whose value are $4,000. That is the growth that you need, but not simple dividends, because dividends are for short term. Dividends sometimes are not paid when shareholders decide that we are not going to pay dividends so that the profit can be plowed back. But as the value of the shares that you put in is the value of the money that you put in the firm increasing. Remember that if you invest in a firm, there are other factors that have to be considered. There is the time value of money, because the cost of capital either increases or decreases. There is also inflation. There are also market forces. So if the share value of the firm you invested in does not increase, that means that the money that you put in it, after 5 years, you'll get even money that is of less value. Let's say $1,000 right now or 1,000 shillings right now will not be of the same value 5 years later, because if the cost of capital or if the interest rate is high or if there's an inflation, the value of that $1,000 dollars or 1,000 shillings will be less, will be like $400 or maybe $500 after 5 years because the value of the money has decreased. So if you invested in a farm whose share value has not increased in all those 5 years, it is like you wasted your money. It would have been better for you to go and make merry with friends or to go on holiday with your wife rather than investing your money in a farm whose share value does not grow. So let us look at examples where you can get information about the share value. The best site to find information about the share value internationally is Yahoo Finance because firms listed in various firms in various stock exchanges have their information in Yahoo Finance. This is a good site of finding the information. If you cannot find the company you want to invest in Yahoo Finance, talk to the person that is convincing you to invest in the firm to give you a historical price of the share prices for over 5 years or for a period of 5 years so that you can check whether the share prices are increasing or they are constant. Then you can make a decision on that. Let's say, for example, you want to check the share prices. This is an example of a stock exchange where you can get historical data about the share prices. This is the Nairobi Securities Exchange. I wanted to check if I can get information about a firm that I was interested in, but this company sells their information. I wanted to check, let's say, like 5 securities that will be viable for me to invest in Kenya. So when I checked the website, I found that they sell their data at about, for 251 files, they sell it at approximately $800 or somewhat $800. But this is one of the sites. So if you have a firm that can give you information about this, let you go search and research before you make any investment decisions in purchasing shares or buying shares from that firm. The other site that you can get information, let's say that was for Nairobi Securities Exchange. So their central bank or their federal bank is called the central bank. Yeah, the central bank has also information about their interest rate in the country. So you can check that the interest rate in the country or the key rate, yeah, the interest rate in the country, the inflation rate is at 8.25%. So before you make investment, you have also to understand this cost of capital. The cost of capital is essential because this is also helpful for you to determine whether you're going to make profit or you're going to make losses, because due to the time value of money, the cost of capital will determine whether it is worth investing in the firm or not investing in the firm. You should also check the risk-free rate. The risk-free rate is the government sells its bonds and its bills, so that if you can invest your money in these treasury bills or treasury bonds, there is a higher chance that you are sure that you will earn a certain interest from investing in these bonds. Rather than you wasting your money going to invest in shares that do not grow, it would have been better for you to buy treasury bonds, which after a period of time when they mature, you will earn a high interest. So that should be the minimum for you. That should be the minimum rate at which you can invest. If you want to invest something for 5 years, let's check here, for example, the treasury bonds that they have. Yeah, there's one for October 2022. Let us check that. Yeah, there's this coupon rate of 12.966%. So it would have been better for you to invest in these treasury bonds which earn you 12.966% for a period that is indicated here, so that your money grows in value, rather than investing in shares that do not earn you any value. this money will be locked here for the period that is indicated. Let's say if it's 5 years, if it's 10 years, if it's 20 years, the money will be locked in the treasury bond. But after the cessation of the period, after the period ends, you are sure that you're going to receive your money, your principal amount plus the interest for the entire period that you applied for those for you bought for the bonds. Therefore, let us look now at Yahoo Finance, where we can find data that is that can help you check whether a firm is worth investing or not. So Yahoo Finance. In Yahoo Finance, there are various firms or there are various market rates which are used. The most used is the S&P 500. S&P 500 is a combination of 500 firms, the share prices of 500 firms in various industries that can give a market rate that can help you decide whether what you are investing in or the firm you are investing in has a higher share value growth than the normal market rate or a lower share growth than the normal market rate. So let us check S&P. Let's check, you can select the dates, the start date and the end date. But I'll just check 5 years because I'm giving you an example of how to check historical data so that we can make investment decisions. October 6, 2017 to October 6, 2022. Click download. That will save the file. You also have to check a firm that you want to invest in, let's say IBM. International Business Machines Corporation, yes. Historical data. We have to check for the same period, 5 years. Yeah. So, something else you can check daily, weekly, or monthly, depending on what you want to check. But for our sake, we'll check daily. Then we apply and download. So let's compare our dataset. Check downloads. I think I downloaded the wrong dataset for IBM. Let's check again for 5 years. Yes, 6th October 2017 to 5th October 2022. And this when you check IBM, the data is daily. 2017, click apply. Yeah, so it is applied. Let's download IBM one, save. So let's check the file. As you can see, the dates are same. So click control shift, then the down arrow, find that the rows are 1258. You can compare with the number of rows here. Control shift down arrow, this has 1267 rows. But I know you've gotten an idea of what we're doing. So since we're analyzing for the same period, we'll save the data set here. We'll use the adjusted closing price or the closing price. So I'll use the closing price. So I'll delete all these other columns. You highlight this, click the shift key, select to this other side, select this, hold the shift key and select this, then delete these columns. Similarly, delete these two other columns because we don't need that. Yeah, so this is S and P 500. This is the market rate. Then let's put here values for IBM, the share prices for IBM for the same period. Where is it? Where is it? There's the file. Yeah, this is the IBM's file. So let's select the data. You're using the closing figures, Control Shift arrow key down, copy. Then we have to paste by this side. So we have to paste figures, right? So the difference is only these few values. You can delete. Yeah, right. So here we have the dates, the share prices for each date. So we want to compare. Oh, did I make a mistake here? Delete that. Okay, so did I make a mistake? No, let it be that way. Now we want to compare the market growth of a combination of 300 firms and the firm where we want to invest our money in. Therefore, we use the formula natural log of the present share prices divided by the previous share prices, right? We use natural log of the current share prices divided by the previous share price. And you will notice that I sorted this value from the newest, which is this month, to the oldest, which was the previous month. Therefore, to the oldest value, which was the beginning of the period where the analysis began, which was 10th September. Oh no, 9th October 2017. That is what I have used. Now, similarly, we do the same for IBM. There's something we have to note here. There's a decrease in share price or share value or stock value from this from 65.60 to 64.50. The share value has decreased by around 110 US dollars, while here the share value has increased by 4 US dollars. If the share value decreases, the value is negative. If the share value increases, this IBM growth value is positive. Therefore, with this has to be computed for all the dates that I have selected to analyze the data. So you move the cursor to the tip of this corner until the cursor forms an addition sign. Then you double click. It computes up to the bottom. Similarly, this also computes to the bottom. Let's check if it has done so. Yeah, it has computed the value until the last value. But you'll notice that this value is division over 0, division over 0. That's why it's an error. It is because this computes or the division value here goes to fetch data here and it finds that it is a blank value. So it is a 0. And that is why this has to be an error. If this has increases to 2, you'll find that we'll have a value here. But since we have nothing here, it will give us an division sign. So this can be deleted, these two. Therefore, you delete this and also you delete this. Now, after finding the growth in the shares, the next step is to conduct a regression analysis to compare the market share prices and the firm that we want to invest in. Whether in the firm that we want to invest in, it has a higher stock price growth than the market, or the stock price growth of the firm that you want to invest in is lower than the market. The best to invest in will be when the stock price of the firm that we want to invest in has a higher growth rate compared to the market. That indicates that the firm is performing better than the market. You wouldn't want to invest in a firm that is performing poorer than an average of 300 firms. it is better to invest in a farm that is performing better than an average of 300 farms. If a farm performs poorer than 300 farms, it is a clear indication that the farm stock prices are not good and it is not worth you making your investment in it. Therefore, we go to data analysis, regression analysis, yes, okay. Then we make the regression analysis. Input Y range. The Y range is the dependent variable, which is the stock price of our farm or the farm that we want to invest in. And this is the stock price. We select to the bottom. Then also we go to the X range, which is the independent variable, which is S&P. Then you press Control Shift and the down arrow key, it selects the data to the bottom. Then you click the labels because the first cell of the data has the labels. So we are going to check this at a confidence interval of 95%. Then we want our output to be in cell, let's say cell G2. Yeah, cell G2. Then let's select line of feed plots. Then we click OK and the computer will compute all that is needed. The S&P value or the slope of the graph is 0.053612. So let's make an analysis on the graph so that we can understand this concept. So we select, let's have a trend line on the graph on the predicted IBM growth. And you double click on the trend line so that we display the equation and the R square value on the chart. And we move this value here so that it can be visible. So based on the equation of y is equals to mx plus c, where m is the gradient of the graph, m or is 0.0536, which is this value indicated here. And also let me highlight it. And also the y-intercept is 9.3 e exponential 0 negative 0.5, which is this. Therefore, this is the y-intercept. This is almost a 0. There's a linear relationship between S&P growth and IBM shares growth. But now we have to conduct a further analysis to check the values, to know whether it is worth investing in IBM or it is not worth investing in IBM. Therefore, first we have to check this value. This value is 0.053612. It indicates that if the stock prices in the market increase by 1, the IBM prices increase by 0.0563. When the share prices in the market increase by 1, IBM stock price or IBM share price increases by 0.0563. When you check the R square value, the R square value even indicates this further by saying that R square often indicates that the percentage change that is explained by the independent variable, the percentage change of the dependent variable indicated by the independent variable. The independent variable in this case was the S&P growth, the market growth, while the dependent was the IBM growth. Therefore, the market growth explains only 0.001. In fact, if you make it a percentage, let's make it a percentage, that it indicates that the market explains only 0.11% of the change in price of IBM. Therefore, if you made your investment in IBM, you are potentially going to see no value after 5 years. Let's say, for example, if one invested in the stock price in the past 5 years, he's only going to experience this significant in significant growth in the share value compared to the market value. While the market increased its value by 1, IBM shares only increased by 0.05612. Therefore, that person that invested in IBM shares 5 years ago would have better invested in a portfolio of 300 firms that could have made him earn higher. When making a comparison to what we checked in the beginning of the video, we checked that the coupon rate was 12.966%. Let me expand this. Yeah, the coupon rate was 12.966%, and the cost of capital or interest rates or the inflation. Let me assume the cost of capital, the interest rate, or the inflation rate was 8.25%. Yeah. Then, assuming that this person, there are two people here. There's person A, then there's person B. Let me indicate him here. Person A and person B both invested 1 million US dollars 5 years ago, and this also invested 1 million US dollars 1, 2, 3, 4, 5, 6 5 years ago. We want to compare who gains value for what he invested in. Therefore, since when you compare this to the market, the share price is increasing only by 0.00053612. That's value. The value of the shares will be 1, 2, 3, 4, 5, 6. Let me assume this times or multiply by 1 plus this. So the value of his money, or he has earned for the 5 years invested in IBM, he has earned 53,611 US dollars. Let's check the person that invested in a coupon rate of 12.97%. How much did he earn? Let's take this 1 million multiply by 1 plus this. And this is an annual rate of growth because the shares increase annually by 12.96%. Therefore, the interest rate, the accumulative interest rate for the 5 years is that. Therefore, this makes a total profit of 648,300. Let me calculate the benefit he gains here is equals to this minus this. While the benefit made here will be this minus this. From the look of things, both made a profit, but the person who invested in the coupon rate earned higher than the person that invested in the coupon rate, the government bonds, earned higher than the person that invested in IBM shares. Therefore, we want to check based on this interest rate who has made profit, because there is also a factor called the time value of money. Let's say this is the new principal plus interest. New principal and gain. Then this is also new principal gain. You have to consider that, or you have to figure out that a shilling right now or a dollar right now will not be of the same value as a dollar 5 years from now. the value of the dollar or the value of the shilling will decrease after 5 years. And that is based on the interest rate or the inflation rate. For this, I'll take the interest rate or the cost of capital or the inflation rate. So I want us to see who will have made a loss after 5 years. Who will have made a loss after 5 years? So let us make the computation. Discounted value. Also, this we make a discounted value. So we are going to assume that this is discounted cumulatively after 5 years. So this will be this value divided by 1 plus the interest rate to the power of 5. Or this is 1 plus the interest rate. I was wondering why it was giving me a very funny figure. Yeah. Then this, let's compare this. It will be is equals to this value divided by 1 plus the interest rate of 8.25 to the power of 5. Check the difference. When the value is discounted, the person that purchased the shares has a value of money of 708,000 US dollars after 5 years. The value of his investment has decreased to 708,000. Therefore, the real loss that the man has made, the real loss that the person has made is this value 708,000 minus 1 million US dollars. While this guy has made a value of a profit of 108,911 US dollars. So this rushed to make investment in shares because his friend convinced him. Unfortunately, he made investment in shares that do not grow, shares that have already matured, shares that have reached the peak value, and they did not grow. Therefore, his money made a loss. He made a loss of almost 300,000 US dollars, while this one made a real profit, though the profits, when computed mathematically, gives you 1.6 million, around 1.65 million US dollars. But due to discounting of the money, due to the time value of money, when it is discounted, he made a profit of 108,911 US dollars. Therefore, before making an investment, there are very basic, very simple things that you can do. Do not just rush to make an investment in shares because you have been promised dividends. Sometimes firms do not pay dividends even to 2 or 3 years. Therefore, if you expected that the share value or you will earn some dividends, in the end, you make a real loss. Therefore, if you want more of such like videos to make investment decisions, please click subscribe, like the video, share so that we can grow together before we make investment decisions. Thank you and bye bye.